Preeti, Raj, Zubin Bhai, and the participants present offline and online both. It is really my privilege to be here today at BCS sharing my knowledge on a topic of PMLA, especially when professionals like chartered accountants, company secretaries have been included and made reporting entity under the law. Friends, what I have done is, what we will do is first understand the basic concept of what is money laundering and why there is this act which is called a PMLA. We'll also understand the FATF regulations or recommendations and the need for PMLA for professionals. What was the need? Then we will move on to this applicability of PMLA to chartered accountant, which is made applicable by its Gazette notification dated 3rd of May 2023. And once you are covered, we need to understand what are our obligations under the law as chartered accountants as well as reporting entities under the PMLA. So it will broadly cover the registration procedure, the policies and procedures, how do you onboard the client, the transaction monitoring, reporting, and other obligations. So let us understand the basics of money laundering. As chartered accountant and being into the field of finance, I think most of us understand what is money laundering right from the days we start our articleship. But to put it, it is the process of making the illegally gained proceeds, that is dirty money, to appear legal or clean money. That is what is the process of money laundering. So why and where is it required? So it would be required for almost all profit generating crime and can occur practically anywhere in the world. And since the objective is to get the illegal funds back to the individual who generated them, the launderers would prefer to move the funds through stable financial systems. So financial systems is something which is exploited the most by the launderers, and therefore all gatekeepers of financial systems need to be extra cautious. So broadly, the international definition says that how does money laundering happen? There are 3 stages, which is the placement, layering, and integration. So in the placement, it is more of dirty money being inserted into the system. Layering would be to separate the proceeds from their criminal origin. And then integration is creating a legitimate explanation for the source of fund. To give you an example, say for example, there is a group of people who are into arms smuggling. Now, once they are into arms smuggling, the money does not have a legitimate source. And therefore, to move them through international jurisdiction or even within the country is difficult because they will not be able to use the digital transfer method. So friends, to understand it in a perspective of an illustration, there's a team of people who are doing arms smuggling, and they have acquired that illegitimate money from this activity. Now it is difficult for them to move across this money through the financial system, and carrying it in cash has a huge risk. So to give you an illustration, what they will do is they will acquire, say, a cafe, which generally would have a lot of cash income, and therefore any source of money that comes in as cash would never be generally questioned by the authorities. So what they will do is they will acquire a cafe, while they may have the regular source of income from the cafe, but they would also start putting this money, which is an illegitimate money, declaring it as income from the cafe. Once that becomes an income from a genuine source, which it appears to be, they can always pay tax and have ease of moving that money across various international jurisdictions, and they would be safe from being suspected of doing something illegitimate. So when we talk about money laundering, it's not only about tax evasion, but it could also be about certain aspects about national security of a country, or some deals which are in narcotics, and that is where is more concerning for any government or a terrorist money, and that is where a stringent law is required to curb this money laundering. So let us go to the historical background of the PMLA. So it started with the United General Nation Assembly, which adopted its resolution way back in 1990, stating that we need to have something to curb the money laundering process. And therefore, every member state, they were supposed to come together, be signatory for exchange of information. While there was a lot of resistance from the member states to sharing of information, which was considered to be confidential for their citizens. But ultimately, an event which occurred in 9/11, which we call it as 9/11, which is the deadly terrorist attack on the United Nations, on the US. The US realized that one of the major reasons for this terrorist attack, which was successful, was because they kept on getting the funds at the relevant point of time. Had there been control over how the funds which are used for terrorist activities being controlled or monitored, probably this act would have been avoided. And that is where the countries came together. US pressurized, put across its pressure on all the countries to adopt this law, which is the anti-money laundering law. Once that was adopted by the United Nations, every member state were supposed to pass the relevant law in their own jurisdiction for control and reporting of such activities, which could lead to terrorism and similar activities. In India, the act was passed in 2002, but since the rules were not made effective until 2005, the act ultimately came into force from 1st of July 2005. If you look at the amendments that have occurred in this act post its implementation, which is 2009, 2013, but if we look subsequent to 2013, almost 2013, there were two amendments, but the change of government which occurred in 2014, we can see that there are multiple and numerous amendments which have been carried out thereafter, right? 2015, 17, 18, 19, 22, and 23. So almost every alternate year, there has been amendment to the PMLA Act to ensure that no such activity which could be a threat for the national security goes unnoticed from the government's radar. And those people who are guilty or accused of crime are punished appropriately. If we look at its applicability, it was even applicable to the whole of India, including the erstwhile state of Jammu and Kashmir. As we all know, Jammu and Kashmir had its own constitution. Most of the laws, including the taxation laws, the GST law, the stamp duty law, did not apply to that state. But since this act pertains to the national security, which comes under the federal government powers, this particular act, which is the PMLA Act, was also applicable to the state of Jammu and Kashmir. The preamble to this act states that it is an act to prevent money laundering and to provide for confiscation of property derived from or involving money laundering and for matters connected therewith or incidental thereto. So let us first understand what is the definition of the offense of money laundering. It is interesting to note here the definition is very, very wide in terms of what it would have been under any other similar criminal law. So if we look at it, it is defined as whosoever directly or indirectly attempts to indulge or knowingly assist or knowingly is a party or is actually involved in any process or activity connected with the proceeds of crime, including its concealment, possession, acquisition, or use, and projecting or claiming it as untainted property. So if you look at it, it is not only the people who have done the money laundering, but even those people or those parties who assist them, even in concealing the possession or acquisition, or even projecting it or claiming it to be an untainted property, they would also be committing an offense of money laundering. So that is where chartered accountants and tax professionals or company secretaries need to be very, very cautious when they are dealing with their clients as to what is the probable risk of not only a client committing an offense of money laundering, but even assisting a client could become or backfire on a professional, because then he would be charged with concealment or projecting or claiming it as untainted property. So it is clarified that a person shall be guilty of an offense of money laundering if such person is found to have directly or indirectly attempted or to indulge, or knowingly assisted, or knowingly is a party, or is actually involved in one or more of the following process or activities. And that includes concealment, possession, acquisition, use, or projecting as untainted property, or claiming as untainted property in any manner. Of late, if we look at a lot of cases where the cases were filed against the accused under the charge of money laundering, we have seen a lot of cases where, including their chartered accountants, were also charged with an offense of money laundering. And not only charged, but they were even imprisoned for a quite substantial period of time before they could get bail. So something which demands extreme caution on the part of the professionals while dealing with their clients. So what is proceeds of crime? So what we need to understand is the offense of money laundering would occur only when somebody deals with the proceeds of crime. Now, to give you an analogy on the previous slide, let's say under the criminal law, if somebody is being charged with a case of a murder, so he has got a contract and he is indulging into a contract killing, he got the money. He has got a contract, he has got the money, and he is going to go and kill somebody. In such a scenario, what we understand is that yes, he is an accused and he should be charged for that particular offense. But here, if somebody has even assisted him, like say, for example, he is going to travel by a taxi and he tells the taxi driver that you need to drive it fast because I have to reach a particular spot and I have to commit this crime. And if that taxi driver actually drives fast and he helps them to reach that particular spot, in a normal course, he is not charged with that particular crime. But here, if you look at this definition, a similar analogy would also make that taxi driver being tried under the same offense as a person who has committed this offense. So that is the difference, and that is where chartered accountants or professionals are supposed to be cautious while dealing on behalf of their client or with their clients. So if we come to the definition of the proceeds of crime, it means any property derived or obtained directly or indirectly by any person as a result of a criminal activity relating to a scheduled offense. Now, this is very important. We will come to scheduled offense. But unless it is a scheduled offense, all criminal activity per se do not become proceeds of crime. So let us understand what is proceeds of crime first. So it says that value of any such property, or where such property is taken or held outside the country, then the property equivalent in value held within the country. And then there was a further amendment in 2019, which says that proceeds of crime includes property not only derived or obtained from scheduled offense, but also any property which may directly or indirectly be derived or obtained as a result of any criminal activity relatable to the scheduled offense. So what has happened, friends, is here broadly, if we try to understand, it says that an offense of a money laundering has been committed. Somebody has received the proceeds of crime. The proceeds of crime are not kept in the same form. Like say, for example, he has bought real estate. He has invested that money into real estate. So it says that even that property which is created out of that proceeds of crime would also become a property which has been derived or obtained, whether directly or indirectly, as a result of that criminal activity. Similarly, there were cases where people went out of the country, they became fugitives, and they realized that if they are out of the country, what is that could be confiscated. So an amendment was brought in and it said that whatever he has taken away, forget it, But if there is an equivalent value which has been left behind, though the other property that is left behind has not been acquired using the proceeds of crime, even that property would be treated as proceeds of crime. So let us understand this. Say, for example, somebody receives 100 crores as proceeds of crime and he converts it into diamond and he takes away the diamond equivalent to 100 crores out of the country. He leaves behind some 40 crores worth of assets in India. The law now says that the other 40 crores of asset which has been left behind in this country, which were not acquired out of the proceeds of this crime, still that would be treated as proceeds of crime. And why is it treated as proceeds of crime? Because the law gives the authority to the prosecuting agencies and the law enforcement agencies to confiscate that property. And that is where it is important to define what is proceeds of crime. So any value which is equivalent to what he has moved out of the country, but what is left behind will also be confiscated. Now, what is offense of money laundering? So if you look at this definition here, it says that criminal activity relating to a scheduled offense. If you look at the words which are underlined on this slide, so very important to understand what is a scheduled offense. So under the scheduled offense, there are three parts, which is part A, part B, and part C. Part A deals with 29 scheduled offense. There are no monetary limits. If any of this act or provisions of the law has been violated, the proceeds that are generated will be treated as proceeds of crime, and therefore it will be an offense of money laundering. As regard part B is concerned, there is only one offense, and that too with a threshold limit, that if the crime is exceeding 100 lakhs, which is 1 crore rupees, then only it becomes an offense of money laundering. Part C will broadly deal with trans-border crimes, which involves multiple jurisdiction, and they have listed those offenses, which broadly include all the laws which are forming part of part A of the schedule. So let us understand what are those offenses and under which law. So broadly, I have listed some of the important laws. Again, when I say this law, it doesn't mean any offense under the IPC would become an offense of money laundering. They have specified certain sections, and if those particular sections have been violated, then only it would become offense of money laundering. But if you look at it, it includes certain acts which we would have never imagined to be part of the offense. Indian Penal Code or UAPA or Prevention of Corruption Act, yes, I may agree to it. But it also includes acts like Copyright Act, the Trademark Act, Information Technology Act, offense under the Child Labor Act, even SEBI Act, the Environment Protection Act, Water Prevention and Control of Pollution Act, Air Prevention and Control of Pollution Act, and of late, they have added the Companies Act 2013, the section 447. It is about punishment for fraud. Now, why it came in? It was after the Island FS saga, where they realized that though there was a provision under the IPC under section 420 to charge somebody under the fraudulent activity, but the government realized that for a corporate fraud, it is extremely difficult to prove an offense under the IPC section 420. While the definition under section 447 of the Companies Act was wide enough to prosecute those people under offense of money laundering, and therefore this offense have now been included under the offense of money laundering. So part A would have 29 entries. Part 2 again only chapter 7 of the IPC, and part C as Black Money Act. So these are the three provisions of the which applies in case of part C, which is pertaining to trans-border crimes. The punishment can range from 3 years to 7 years, but if it is relating to narcotics, it may extend up to 10 years. Again, we come to a very important aspect as regards implementation of the PMLA law. In case of any law which has been passed by the parliament, generally we have a law and we have an enforcement agencies which monitors or generates intelligence reports on those violations, and then it itself prosecutes it. Like if we take the case of direct tax, we have a governing body which is CBDT. It will have its intelligence arm, and we will also have a prosecution arm. If we look at indirect tax, we have CBIC or customs. I mean, for customs also. And but here, what was envisaged was that since this act is going to monitor one of the key aspects of any criminal activity, which is finance, we need to have an agency which is a kind which acts as a nodal agency. It generates intelligence from multiple sources, compiles it, collates it, and then that information is shared with multiple law enforcement agencies to ensure that no aspect of any laundering activity goes undetected by any of the agencies. So here, if we look at it, we have two agencies. The first is the Enforcement Directorate, which is concerned with the prosecution, which we keep on hearing ED has arrested so and so, they have prosecuted so and so. And the second arm is the Financial Intelligence Unit, which is kind of a nodal agency for collecting intelligence information. So any intermediary or like a case of a chartered accountant is concerned, what we are supposed to do, we are supposed to generate intelligence for them, share those reports with them, which is the Financial Intelligence Unit. If any crime is committed, it is the ED which will prosecute the offender or the criminal for that aspect. So what we will deal with in today's session is more with the functions of FIU, because that is where we will be interacting as reporting agencies, and we need to understand the law in that particular aspect. So what is the broad role of FIU India? It is collection of information, analysis, sharing of information with various law enforcement agencies, act as a central repository of the information that has been collected, keep on doing research and analysis on that data or data sets, and make that data available as and when required, even at a future date. So the reporting entities are broadly defined under Section 2, Subclause 1, Clause WA, and it includes banking company, financial institutions, intermediaries. And then there is a residuary clause which says a person carrying on a designated business or profession, and this has to be notified by the government. So this is not part of the act, but the government can notify any person who is carrying on the designated business or profession to be a reporting entity. So a lot of chartered accountants have, come across cases where recently the real estate RERA registered agents, they have been issued notices that why have they not been registered with FIU despite being a reporting entity. I understand some 15,000 notices have been issued. So because they have been notified as persons who are carrying on designated business, and therefore they are supposed to register themselves. So same is the case with chartered accountants. Now let us understand that what was the need to bring in chartered accountants within the ambit of reporting entities. Because like if we look at bank, they handle clients' money. Or if we look at intermediaries like stockbrokers or portfolio managers or AIFs or mutual funds, they do handle clients' money. Whereas chartered accountants are not supposed to handle clients' money. And then what was the need? So it comes from the FATF. FATF is a global agency, which is the Financial Action Task Force. And its job is to watch out for dirty money and terror financing. It sets standards for the countries to fight the financial crimes. It evaluates countries and offers improvement for suggestions. So we all know Pakistan was put under grey list for a substantial period of time, or even for that matter, UAE, which was under grey list because they couldn't comply with the set standards on anti-money laundering provisions. So what they do is they classify the jurisdiction based on the risk level, which could be black, gray, whitelisted, and so on. So India joined the FATF in 2010. And the good part is that we had our last evaluation done in 2023. India cleared 37 of the 40 stringent evaluation parameters on that test and is now in the FATF's exclusive club of top performer 3 countries, joining UK, France, and Italy from G20. And we have even surpassed US, China, Germany, Japan, and Canada. And we have standards which are much more than existing in those countries on anti-money laundering provisions. The question is, what is the benefit? The benefit is, it's like a certificate. So if you get a gold medal, people recognize you. Similarly, when FATF recognizes you as one of the top 3 performers in the globally, those financial institutions who deal with this country or institutions within this country, they are rest assured that they are not dealing or getting entangled into businesses which could be at the back end into offense of money laundering, including terrorist financing. So that is the assurance that they get. So if you look at Pakistan, when it was grey listed, a lot of money stopped flowing into Pakistan because FIIs or institutions were concerned putting that money into that country. Because when they pull out that money and when they go back to their home country, there will be a lot of scrutiny because they have invested in a country which is grey listed. Similarly, UAE also faced a lot of problem because they were not able to implement those standards, which ultimately they did it some 6 months back, and now they are out of that grey list. So for every country, it is very mandatory that they are able to prove their credentials on implementation of the anti-money laundering standards. Now, what was the need for professionals to be encompassed or being made as a part of the reporting entities for PMLA? So this again comes from the FATF recommendations, which is recommendation 24 and 25, which focuses on identifying and mitigating terrorist finance risk associated with designated non-financial business and professions, and also emphasize customer due diligence measures for designated non-financial business and professions to prevent accounts being misused for money laundering. So these were the 2 recommendations. And since in 2023, we were supposed to be evaluated by FATF, had we not implemented these 2 standards or recommendations of 24 and 25, encompassing professionals under PMLA, we would have not achieved what we were able to achieve in the FATF evaluation. So this was one of the global compulsion why the professionals were included. The inclusion of accountants and legal professionals as reporting entity under PMLA is a global trend. So it is not that only India has done it. Countries like US, Canada, UK, Australia have already implemented such measures where the professionals like lawyers, advocates, company secretaries, chartered accountants, they are part of the reporting entities to ensure there are adequate curbs on money laundering. So let us get back to what is our today's agenda of the meeting, which is the 3rd May 2023 notification, which made the PMLA applicable to chartered accountants. So let us read this, important aspect of this notification. It says following financial transactions carried out by a chartered accountant in practice. So chartered accountant who doesn't hold a certificate of practice is not covered under this. I'm not saying he is not covered under the PMLA. I'm saying under this notification, because there are other laws which would also cover those professionals even if he doesn't hold a COP. So here it says accountant in practice on behalf of his client in the course of his or her profession shall fall under the purview of PMLA if. So there are 2 or 3 important aspects. First, he has to be in practice. Then he has to be, the activity that he's going to do has to be on behalf of his client, and it has to be in the course of his profession. So what are those activities? It includes buying and selling of immovable property, managing of clients' money, securities, or other assets, management of bank savings and securities account, organization of contribution for creation, operation, or management of companies, creation, operation, or management of companies, limited liability partnerships or trust, and buying and selling of business entities. While all other are more or less business or professional activities, a word of caution is for the trust. There are a lot of chartered accountants who become trustee out of their obligation towards the society, not as a part of their profession. But if you hold a COP, you are covered under this. And if you are charging any fees for being a trustee or for such other services, then you are definitely governed by this circular notification. So broadly, it has to be somebody who is a chartered accountant in practice, carrying on a financial transaction on behalf of his client and in relation to the specified activity. So these are the 4 conditions that a person would have to fulfill to get covered under this notification. And to summarize, it is funds which are resulting from these specified activities related to financial transactions or required for execution of those transactions are routed through or managed by chartered. So that is what is very important, that it is routed through or they are managed by a chartered accountant. And we have seen a lot of cases where, because of the trust factor, there are a lot of NRIs who have given the power of attorney to their chartered accountants to operate even their business accounts, not only their savings account, but even their business accounts. So I have seen a lot of chartered accountants where they act as virtual CFOs. They have the authority and they hold a COP as well. And they have the authority to operate those business accounts. There are people who are into trading of securities. They authorize their chartered accountants as a professional that I will give you instructions, and based on those instructions you get, I mean, you buy or sell the shares or securities. So again, that is covered under this definition. So the moment you fulfill all these parameters, a chartered accountant in practice would become a reporting entity, and therefore he is required to register himself first as a reporting entity and then follow all the guidelines which have been made mandatory by FIU India jointly in consultation with ICAI. So an immediate question that would arise in somebody's mind is that I'm a chartered accountant and I make tax payments on behalf of my clients, which we generally do as chartered accountant because client transfers the funds to our account and in turn we pay taxes for them. Does PMLA apply to this transaction? ICAI has clarified that no, not all clientele related payments handled by chartered accountant fall under PMLA. So the following payments have been expressly exempted from PMLA, and that includes taxes, which is payment of taxes on behalf of clients, statutory fees and levies, and registration charges and fees for other professionals, such as senior counsels. Like if there is a case which is to be represented before the tax authorities, and the chartered accountant, at the instruction of the client, has hired a senior counsel to represent the client's case. The client makes the payment to a chartered accountant, and the chartered accountant in turn makes the payment to the senior counsel, because that's a consolidated contract where it would include the counsel's fees as well as the chartered accountant fees. The client is given a consolidated charges. So in that case, it says that no, PMLA will not apply for such transactions. I have tried to make it more in the form of an Q&A or FAQs, because these are the doubts which people keep on asking when we hear about PMLA. So the question is, are the following services which are provided by chartered accountant covered under PMLA? Which could be like writing books of accounts, auditing and attestation functions, special purpose audit reports, furnishing of returns to direct tax and indirect taxes, tax audits, service under FEMA, RERA, etc., paying taxes on behalf of clients, application for PAN, TAN, GST, trademark, etc., incorporating companies or LLPs or trust on behalf of clients, incorporation of companies, project financing. Again, this has been exhaustively given in the FAQ issued by ICI. I have picked up those selectively those FAQs from the ICI guidance note itself, and they have given these answers. It is not my answer. Books of accounts, no, it is not covered if you are not managing clients' bank accounts or funds. But there are a lot of entities where they outsource it completely, especially the foreign entities, because they do not want a PE in India. So what they do is they only have a sales or a representative office, and entire accounting is outsourced to a CA firm, where they are even authorized to manage clients' bank accounts. So if that is the case, yes, you are covered under PMLA. But simply writing books of accounts for clients, that is not covered under PMLA. Audit is not covered, special purpose audit not covered, filing of returns not covered, tax audit not covered. Again, FEMA, MCA, RERA, if you are not managing clients' bank account or funds, not covered. Paying taxes, not covered. Application for PAN, TAN, GST, etc., not covered. Incorporation of companies, LLPs or trust, not for buying or selling purpose, because there are a lot of chartered accountants. What they do is they incorporate the company in their own name, and then they sell out these companies to the clients when they are in need of such companies, because that saves or helps the client to save the incorporation time. So if you are doing it on your behalf for buying and selling, it is covered under PMLA, but otherwise it is not covered. Simply incorporating a company or LLP on behalf of client, not covered. Project finance, surprisingly, ICI guidance says, yes, it involves organization of contribution for creation, operation, or management of companies, and therefore these transactions will be covered under PMLA. Now, what would happen when it gets covered under PMLA? We will see it later. Whether the CA acting in the following capacities are covered under the notification. So we chartered accountants act in various capacities on behalf of client, for the client. So it could be official liquidator, insolvency professional, independent directors, nominee directors, recovery consultants, executor of the will, insurance brokers, trustee. So the answer that has been provided by ICI is official liquidators, insolvency professionals, independent directors, nominee directors, recovery consultants. Up to nominee director, they are not covered under PMLA. Recovery consultant, yes, it's a management consulting services if you are providing it, because there you deal with clients' money, you recover the money on their behalf and then pass it on to the clients. Executor of the will, yes, applicable only when a client relationship is established. Friends, this is where I would like to take a pause for a moment and express my apprehension on how do we manage these things. A lot of time, what happens is over a period of time, our clients become more like family members and friends. They are less of a client and more of a friend. And in fact, those clients trust their chartered accountants more than they trust their legal heads, their family members. So out of their trust, they ask chartered accountants to become the executor of the will. Now you may be filing and providing some other services to them as well. And the moment you do this and you become an executor of the will, you are covered under PMLA. If you are accepting this as a pro bono activity, please get a express letter from the client, make your understanding very clear that you are doing it pro bono and this has nothing to do in your professional capacity as his chartered accountant, because otherwise you will get covered under PMLA. So a stray incidents like, I am filing a return for my uncle and he pays me some nominal token amount of fees. And tomorrow he wants me to become an executor of the will. I accept that job because he is my family member, he trusts me. But I have not taken a letter saying that I am doing this not in my capacity as a chartered accountant, but as your relative. If I don't do this, this activity will get classified under PMLA. And therefore, you become a reporting entity. You will have to comply with all those provisions which otherwise would apply to any reporting entity. Insurance brokers, it says yes, because it involves managing clients' money. Trustee. If it is a public trust, it says no, since it is for altruistic purpose and not in the course of professional assignment. But a word of caution is that you make it very clear in the appointment letter that this is not being done as a professional assignment, because otherwise it could be a bit problematic, especially those trust of ultra HNIs when they get entangled into problems and those government agencies and ED start enforcement agencies, they are after them. They would also catch hold of a chartered accountant because he becomes the easiest and the softest target available to them. If somebody is working as a trustee in a private discretionary trust, yes, it would be in his course of his professional service, and therefore it would be covered. So this covers the same thing, I mean, what we have discussed, where a relative has given you a power of attorney. Sorry, the question is, as a chartered accountant, if I handle financial transaction using a power of attorney, will the POA apply? I mean, will the PMLA apply to me? The second is, one of my relative has given me a power of attorney to manage his financial transaction due to his old age. Will I be treated as a reporting entity? The answer to first is yes. CA in practice executing certain financial transaction under a power of attorney will fall within the purview of PMLA, and therefore it is crucial to remember that this applies if the transactions are carried out in the course of your profession. If it is not in the course of your profession, get it expressly signed as a letter. The answer to second question is no, but advisable again to take an engagement letter confirming that it is in your personal capacity and not as your professional capacity. So what is expected from you is a well-defined scope. This will help you to get a clarity on whether it is a professional assignment or a personal assignment. It will help you to identify PMLA relevant transactions. When you outline the activities which are covered under the engagement letter, you are able to identify whether those activities will fall under PMLA or not. Example, whether you are required to manage client funds, you are required to buy or sell properties on their behalf. And this will help you to focus on the KYC documentation and the reporting requirement that you are supposed or obliged to do under the PMLA. And this will all the more help you protect yourself because it serves as an evidence. So does this mean I can just ignore PMLA for all the personal transaction where I get involved? The answer is yes. You may ignore the third way notification, but remember that you can be prosecuted or covered under other provisions of the PMLA, including the Code of Ethics of ICAI. So what are the obligations of the chartered accountant as reporting entities? To verify the identity of its client along with the beneficial owner, to maintain such records and for such period as may be prescribed, to report to the concerned authorities, including the FIU, as per the prescribed procedure and manner, and to carry out enhanced due diligence wherever required. So let us say that the moment somebody is covered, now let us first identify at this stage, look at all your clients and engagements, identify whether any of the activities that you are rendering to your clients would fall or make you classify as a reporting entity, because there are parameters which they have defined. If we look at, so here it says that what is required is that you have to be a practicing chartered accountant. You are carrying out financial transactions on behalf of the client and in respect to the specified activities. So what are the specified activities? Which are numbered 1 to 5, which is buying and selling of immovable property, managing of clients' money, management of bank savings account or securities account, organization of contribution for creation, operation, and management of companies, creation, operation, or management of companies, limited liability partnerships or trust, and buying and selling of businesses. If any of your activity gets classified into this activities, that is where PMLA applies to chartered accountant, not otherwise. So if you are doing any such activity, then let us understand what are the obligations of the reporting entity. But if not, then you are not covered under PMLA. So let's understand if you are covered under PMLA, what is your responsibility? How do you go and implement this within your organization? So first and foremost is you will have to go and register as a reporting entity with ICI. You will have to establish policies and procedures, which includes appointing a principal officer and a designated director. A lot of firms ask that we are not, we are a partnership firm or a proprietary concern or an LLP. We do not have designated directors. So designated directors doesn't mean here the directors appointed under the Companies Act. This is a special designation which you are supposed to give to people within your organization at the highest level to make them accountable and to ensure that the PMLA guidelines are implemented within your organization. So they are like a nodal officer where you appoint them as principal officer or designated director. Now, having done this, what are your obligations? So the first thing is the client onboarding. When you engage a new customer, you will be required to do their KYC. You will be able to do a customer due diligence. If required, you will have to do enhanced due diligence on your customers, and you will have to do a sanction screening. Now, what is a sanction screening? Sanction screening here means that there are individuals and entities which have been classified by the United Nations as terrorist organizations. When you onboard an entity, you will have to identify not only the entity, but the end beneficial owners of that entity and do a sanction screening whether any of those entities or the beneficial owners are in any way connected with the entities which have been debarred by the United Nations. So let's take an example. Say during COVID, we came across a lot of cases where there were certain entities which were incorporated by chartered accountants and company secretaries, and government subsequently said that these were all Chinese conduits which were doing money laundering, where chartered accountants and company secretary not only helped them incorporate the company at giving their addresses, but some of them even agreed to become directors on their board and run the company. Now, say for example, you are in some way or the other engaging with such clients. You know somebody has approached you who could be your friend, consultant, lawyer, or a businessman. And he said that will you incorporate this company? Which generally as a part of the professional engagement, we do accept such. When I, as a chartered accountant, am going to incorporate this company, I will have to first identify who are going to be the shareholders, who are going to be the directors. It could happen that one of the shareholder or two of the shareholders are LLPs, corporates, or trust. They are not individuals. In that case, I will have to ask that entity that if there are LLPs or companies which are coming in as your shareholders, you give me their shareholding and directorship patterns. Again, within those entities, there could be one more layer of entities, maybe within the domestic jurisdiction or somewhere outside the domestic jurisdiction, where they would be controlled through trust. So if it is a trust which is going to control, say, from Cayman Islands or British Virgin Islands, I will have to ask that who are the ultimate beneficial owners of that trust. Because ultimately, what I am supposed to do is, I am supposed to identify the UBO of an entity with which I am getting associated. And through those screenings, I come to know that ultimately there is one beneficial owner who has some connection with a grey listed country under the FATF charter. Like say, for example, he belongs to North Korea, or he has a business set up in North Korea, or he's from Pakistan, or he is from Iran. The moment I get that, that comes into my enhanced due diligence now, because he is a high risk customer. So similarly, India has also given a notification that any country which shares border with India, and if an entity from that country is going to be incorporating an entity in India, that is going to be a high risk entity. So when I do a sanction screening, I should identify where are those directors or shareholders coming from. And generally what happened in this case of Chinese companies, they had an entity in India and this became a step down subsidiary. When somebody would have asked who is the ultimate beneficial owner, then you would have found that they had some connection in Singapore. And if you go back to Singapore, you would identify they had some Chinese connections. So it was not a direct Chinese citizen coming and incorporating a company in India, whereby it would have been easily identified by a chartered accountant. So this is a little lengthy process, but utmost diligence is required to be exercised. So the question is how difficult it is. It is, I would say, if the client is cooperative, it is not difficult. But most of the times you find client being non-cooperative and they even threatening you that if you keep on asking me so many questions, either I do not have the wherewithal to answer you, or I am least interested because there are thousands of other people who do it at a much cheaper rate and ask much questions, I mean lesser questions than you are asking. You may lose out a client, I agree to that. But if a client is cooperative, it's not that difficult because then you would have.
Then it's obviously very easy.
Correct.
I mean, it's just...
Correct. But see, it's a question of national security.
Correct.
And I mean, it is, I mean, and it could put your career at stake. And understand when you receive a summons from ED, the best of the people, I mean, they have sleepless nights. Correct. And as chartered accountants, I'm sure we would have not made such kind of money, nor we would be willing to take such kind of risk to receive summons from you. So that is where it is very important that we do this. There are softwares available. It's not that difficult if you use those softwares. Having onboarded this client, what is required is you are supposed to monitor the transactions, identify suspicious transactions, and do a counterparty screening. This is something which is not required for any other reporting entity. It is only the professionals who have been given the responsibility of counterparty screening. Now, what does this mean? It means that if I have a company which has been incorporated in India and I'm working as a virtual CFO for that company where I'm authorized to sign the checks, do the fund transactions, and I got a call from a holding company CFO saying that we are buying a property, say in Hyderabad, and you transfer 1 crore rupees to this particular entity in Hyderabad. As an attorney holder, I mean, because I work as an attorney holder technically when I'm working as a CFO, I would have transferred the money. But what the law says is that you will have to do as a chartered accountant the KYC of the party to whom this money is being transferred before you sign the check and transfer the money. So the entity which would have otherwise not given that details to the entity for whom I am working, but I am still obligated to obtain those documents. So this is something which is really difficult, very, very onerous. And that is where chartered accountants should really think over before they accept these assignments, whether client would be willing to cooperate and safeguard your interest. After doing all this, if you find something which is suspicious, you are supposed to report it to the Financial Intelligence Unit through ICAI. This is again an exception. All other reporting entities are supposed to report directly to the FIU India. They are supposed to be registered with FIU India. It is only the professionals, which is chartered accountants, cost accountants, and company secretaries, who have been required to register only through their professional bodies and not directly with FIU India. Other obligation is maintenance of records, employee training, and periodic review. Now let us take each of this one by one in detail. So what are the registration obligations? So what is the registration of a reporting entity? A practicing chartered accountant engaging in specified activities shall register with ICAI by filling up the form provided by ICAI. So if you are a reporting entity, connect with ICAI. They have a special web page on the ICAI website for PMLA. Download the form. I have also given the link to the form in case somebody needs it. The material will be circulated. And fill up that form, submit it to ICI and get registered as a reporting entity. The reporting entities should have policies and procedures related to. First is the appointment of a designated director and principal officer and a branch level compliance officer. Again, an exception. Nowhere the reporting entities are required to have branch level compliance officer. It is only the CA, CS and ICWS who have been mandated to have branch level compliance officers. All other reporting entities only have two categories of people, which is designated director and principal officer. Having done that, you will have to have policies for customer identification, customer risk profiling, customer acceptance. Whether to accept that customer or not should have a policy based on risk profiling and identification. Having accepted a customer, you will have to keep on monitoring those transactions of those customers. Identify the red flag indicators in the financial transactions. Again, the list of red flags have been given by ICI. You will have to have policies and procedures for reporting mechanism and maintenance of records. So these are the policies that every reporting entities should have. Whom they should be appointing. So appointment. If it is a firm or a proprietorship concern, the reporting entity is supposed to appoint a designated director who shall be a managing partner or a proprietor and appoint any other officer or additional officer as a principal officer. If you do not have any competent other person, the same person may act as designated director as well as principal officer. For individual professionals, again same, they may serve as the principal officer and individual professional is not required to appoint a designated director. The roles and responsibility, what is designated director supposed to do? Is supposed to ensure overall compliance with obligations under Chapter 4 of the PMLA Act. And principal officer is supposed to ensure reporting of all the requisite transactions under Rule 8. The overall objective being implementing internal mechanism, communicating firm-wide policies, and ensuring compliance with statutory requirements. So what are the steps involved in implementing PMLA, practical implementation? So when you are going to onboard a customer, you will have to do a customer identification, which we discussed, which is the end level UBO verification have to be done. The customer due diligence, which is where you will have to identify what is the risk, whether they appear to be genuine or they have some problematic areas identified. Having done that, you will have to identify the risk. Risk could be based on the geographical risk or the people who are going to manage it. So as I said, I mean, example could be somebody who is a company who has a director who has business association in North Korea. So that becomes a risk profiling. So you will have to do this such kind of risk profiling. Sanction screening. If any of the UBOs or people at the helm of the management, they are in the sanction screen of the United Nations where they have been debarred, you are not supposed to do business with such entities. Based on all this, you will have to identify the risk of that entity with which you are getting associated. You have to classify them into high, medium, and low risk. Having done that on an ongoing basis, you will have to do an enhanced due diligence. A normal transaction may not be monitored so closely, but having identified the risk of such transactions, you may have to do enhanced monitoring. Each of the transactions should be monitored and counterparty screening should be done. Based on this, if there are any suspicious transactions, you will have to report it to ICI through, I mean, to FIU through ICE.
One more question. This provisions have been introduced recently. What about the practices which are there since last 20, 30 years, 40 years, and you have existing clients also who are almost equally older, at least already an existing client whom we have not been screening in this detail through SBO. I mean, ultimate beneficial ownership, still we've not gone through. So for that also, is there any time limit or any threshold? I mean, are we supposed to do it or is it prospectively for new clients?
No, it doesn't say about new client. It says that the moment you have now become a reporting entity, start doing it even for your existing clients.
So is there any time limit where
No,
for
they have not
completing
specified.
the
No, they have not specified
profiling?
time. So
Because
practically,
it's quite elaborate procedures
correct.
to follow that.
So there are a lot of clients who say that, I mean, especially those coming from other jurisdictions, that in India, the regulators have a policy of implementing things from T-1. So overall, what is required is a robust mechanism for complying with the KYC requirements prior to onboarding a customer, carrying out re-KYC on a periodic basis, and continuous due diligence of existing customers. Again, there are a lot of people who think that this is a new requirement, but let me tell you, friends, on 1st of January 2017, ICAI, by its resolution, have already made KYC mandatory for all attestation functions. So whenever you do attestation function, a KYC has to be done for that client. And according to that notification of 2017, these are the kind of documents that you are supposed to obtain, which is the KYC norms as prescribed by ICAI. So what is the purpose of client identification? The aim is to verify and identify both individual and non-individual clients, which includes companies, trusts, which are engaging in financial transactions, and they extend to identify the beneficial owners, or rather, I would say, ultimate beneficial owners. So who is a beneficial owner? So the definition of a beneficial owner means an individual who ultimately owns or controls a client of a reporting entity, or the person on whose behalf a transaction is being conducted, and includes a person who exercises ultimate effective control over a jurisdictional person. So even if it is an entity which is a jurisdictional person, you will have to identify ultimate beneficial owner of that entity. And what are the criteria for identifying the beneficial owner? So they are based on the percentage of the shareholding or profit. They have a threshold. If somebody is holding a percentage above that, that is where you are supposed to do a beneficial ownership test. Client due diligence. The objective is identification of verification of clients, carrying out risk assessment, applying enhanced due diligence wherever required, and continuous monitoring of transactions. So what is the purpose of risk profiling? So based on risk profiling of the client, you will decide the extent of the due diligence that is required, the frequency of due diligence, and transaction monitoring could be established. What kind of information would be used for risk profiling? So information such as nature of employment or business, geographical location, publicly available information, etc., can be used for risk profiling of a client. Some factors that should invariably be considered is factors such as politically exposed person. Again, politically exposed person here doesn't mean everybody who's into politics. They have defined what is politically exposed person. Their involvement, their cross-border transactions should also be considered. So what is a PEP, which is generally called as a PEP, which is politically exposed person. So it is an individual who has been entrusted with a prominent public function by a foreign country, including the heads of states or governments or senior politicians, senior government, or judicial or military officers, senior executives of state-owned corporations, and important political party officials. So if any of these people are going to be the beneficial owner, or they are going to be the ultimate people who are going to manage these institutions, then this would come under extremely high level of risk, because these entities would have exposure, or they are being controlled by politically exposed person. Sanction screening has to be done at the time of onboarding, and whenever there are any notified activities as per the notification, you will have to do a sanction screening. The link to the sanction link list have been provided by the ICAI. I have provided this link here. Risk exposure we have already covered. Policies and procedures we have covered. Documentation we have covered. So what is enhanced due diligence? It refers to rigorous and robust measures undertaken by a relevant person when dealing with complex, unusually large transactions or unusual patterns of transactions with no apparent economic or lawful rest. So if you look at those Chinese companies, when they made these mobile apps, they started lending out money. the money was being given at a very, very cheaper rate initially. The objective was just to rotate that money and appear as if it as a legitimate source. So if you look at those transactions, you would identify that why would somebody do such kind of a business? There is no logic or no rationale. So as a chartered accountant, generally we are only used to looking at the numbers which appears in balance sheet or the tax provision figures. But here, when you are doing such activities, what the law says is that you look at it from a telescopic view or rather a microscopic view, understand what is the rationale of this activity, why is this entity getting into this activity, is there any logic, is there any rationale, and if there is no rationale, that is something which is suspicious. When should it be conducted? It says when the risk of money laundering, terrorist financing, and proliferation financing are higher. But the question is, how do I know when it is higher? It is only when I do this entire process I come to know it is higher. So basically, there are no exceptions. If you ask, so some indicative measures of PDD. What it says is you frequently review your customers. You ask for their financials. You ask for their credibility. I understand if you keep on asking for so many things, he'll say that you are asking more things than what an income tax officer would have asked me. You are scrutinizing me more than the officer. Application of additional measures like gathering information from publicly available source. This is what most of the times we chartered accountants don't do about our clients. We just have a meeting with them, we take them at face value. But the law now wants us to be Sherlock Holmes, understanding what our client does, what is his background, do a background check, understand his activities, what kind of problems he could be facing, where he is associated, where he is connected, what activity he does, and then identify whether he looks to be suspicious. So the reasonable measure to know that the source of the fund is commensurate with the assessed risk of customer and product profile, which may include conducting independent inquiries on the details collected or provided by the customer, consulting a credible database, public or otherwise. Now, if you look at it, there are a lot of issues which arises, like the case of Mahadev, where there was a huge trans-border money laundering. If you look at the economic rationale, you realize that there were no economic rationale of building that app. But the ultimate objective was you collect small amount of fees for people who come and play those games on your app. You put huge amount of cash into your bank account saying that this is my revenue from a genuine source. And then you launder money between UAE or rather countries in Gulf and EU. And that was actually being done without movement of funds because they had people here, they had people there, and the transaction used to be happening only through a book entry. So that is where it's difficult to identify, but yes, the responsibility has been now casted on the professionals. So the question is, what is suspicious? How do I identify suspicious transactions? And it broadly gives a definition of the suspicious transaction as, and it says includes an attempted transaction. Now, this is something which scares me a lot. To give you an example, a customer comes to me. He says that I want to incorporate a company. I say, you give me your UBO, the beneficial ownership, you give me the list of directors, you give me their identity proof, address proof, their financial background, their geographical background. I collected everything. Then I said, okay, you have this entity, which is a non-corporate entity. You give me the details of the directors of that entity. He says, they are not in India, they are outside India. I said, nothing doing, I want it under the law. Call for. He doesn't come back. That becomes an attempted transaction. So you are supposed to report. So even if he is not coming back, he is not sharing the detail, is an attempted transaction. Transaction was attempted because of your due diligence. He has not turned up. Now it is your responsibility to inform FIU or ICI saying that there was an attempted transaction. Now it is difficult on a large scale for a CA firm when a lot of such activities would actually be delegated downward. You have a team size of 200 people. Obviously, the KYC is not done by the managing partner. You meet a customer, you get the customer, and then you ask your juniors that, okay, you do this formalities. He may have not completed it. In the meantime, the client stops communicating, he doesn't turn back. As a managing partner, the information has to flow upward, stating that there was an attempted. So the procedures have to be implemented, which is difficult, but yes, required. Whether or not made in cash, which to a person acting in good faith gives rise to a reasonable ground of suspicion that it may involve proceeds of an offense specified in the schedule to the act, regardless of the value involved, appear to be made in circumstances of unusual or unjustified complexity, appears to have no economic rationale or bona fide purpose, gives rise to a reasonable ground of suspicion that it may involve financing of the activities relating to parents. The definition itself is so wide. In hindsight, it's always easy to say that, okay, this should have aroused your suspicion. But in the midst of a transaction, when you are doing it in a short span, it's really, really difficult to apply a mind. I mean, your junior may not apply his mind. It has to be monitored by a senior. The senior should understand the implications of this transaction and then report it to the level of the managing partner, such petty matters. And then the managing partner or the principal officer is supposed to report it to special attention should be paid to all complex, unusually large transactions and all unusual patterns which have no apparent economic or visible lawful purpose. This is very, very important. In the hindsight, it would be very easy to say that it was unusually complex. And you look at all the frauds that have occurred, you will have this pattern invariably.
Reason is a very subjective term.
Correct. So in the hindsight, it's easier to say and establish, but when you are in the midst of a transaction, how do you identify that? So that's your procedure, which has to be very, very strong.
The robust system to.
They will have to identify the transaction based on the red flag indicators provided by the ICI. So what are the red flag indicators? Red flag indicators are signs that suggest a transaction or activity might be related to money laundering. So some of the indicative red flag indicators include client receives unusual payment from an unlikely source which is inconsistent with his sales. So say for example, he is dealing into chemical and he does a sale transaction for gold and receives money from a gold. This is something which is very unusual. Why should we have received a money from gold? Generally, we don't go into those details. For us, it is a number. We put it in the sales and we analyze it. We never look at the commodity that was purchased or sold. The client appears to be living beyond declared income or turnover. So you will have to look at his personal living patterns. Where is a member? Which club? Where does he go? What does he do? Even post office hours. Client obtains loans from unidentified parties. Most of the time, we are the people who are asked to defend him before the tax authorities, but here we are supposed to scrutinize. Client obtains loan on a relatively low income basis. We have come across a lot of cases where a thinly capitalized company of 1 lakh rupees has issued 100 crores of loans. Transaction where there is lack of information or explanation, or where explanation is unsatisfactory. Again, your documentation will speak for it. Transaction with companies whose identity is difficult to establish as they are registered in countries identified as tax havens or known for their secrecy laws.
If suppose you are not satisfied with the explanation of the client company, which is a corporate, and you have qualified the financials, does it?
No, if you are a statutory auditor, then you are not a reporting. You are working as a virtual CFO. Yes. No, that would be under different law, not under the PMLA.
NAFRA and other authorities can.
No, I'm not talking about that. So let's say that I'm a statutory auditor of a district. I will discuss the back end subsequently, but just to I'm a statutory auditor of a district company. So company that enters into the transaction. Seven books of that company and charges them under active products, section 12. Now let's say there is some cash transaction in between. It is a, should be
But then
That
see,
is a different
PMLA
obligation.
clearly says that if you are a statutory auditor of a company, you are not handling money on their behalf. And therefore, you are not a reporting entity under PMLA.
right? Whether it has any substance or whether transaction has any substance or not. So in this case, the holding company sells goods to the subsidiary.
No, let me clarify what we are discussing here is a chartered accountant who is into practice and handles money on behalf of the client. That is where the PMLA would apply because he becomes a reporting entity. Correct? As a statutory auditor, your obligations are different.
As I discussed,
Okay.
can see
No, no, what I just wanted to say, what I understood is basically suppose you're virtual CFO of a company and you know the company's income is only 1 lakh. Or they are earning 1 lakh or 5 lakh, but the director is having a Rolex watch in his wrist or something like that. Then in that case, there is a red flag indicator.
Uh, then there are many large cash transactions when not expected. Apparent use of personal account for business purpose. Client match with UN list, UAPA list, other criminal or terrorist financing list, or FIU alert list. Use of wire transfer and internet to move funds to and from high-risk countries or geographical locations. I have given this a screenshot from where you can identify and download this red flag indicators on the SSP portal of the ICAI. So if you log into your SSP portal on the dashboard, the text which is PMLA compliance, which I have circled in black color, that's a link from where you can download those red flag indicators. Even if you are not covered because you are not handling client money, I would recommend at least go through those red flag indicators. They are really helpful in terms of when we are handling professional assignments of clients in our professional capacity. So again, the REs are required. RE is the reporting entity. They are required to conduct counterparty screening when acting on their behalf of their client. This is something which is really, really very difficult because the client would not like. I mean, say for example, I am working as a virtual CFO of a company which is into export of goods or services, or they are into importing something. As an exporter, they are not required to identify the client under their business requirement. But if I act as a virtual CFO, I should be asking their client to establish your identity first, and that is where I will sign the check to make the payment. Will my client like I asking those questions when he is not under that obligation? I think that's really difficult, but yes, that has been casted as a responsibility obligation on CFO. Ascertain any emergent risk stemming from any suspicious transaction history, adverse media or public information about a regulatory or a criminal penalty related to their client's counterparties. So if I come to know that I have a client on whose behalf I am working as a virtual CFO, they are exporting goods to a client, say in Dubai, and that client in Dubai has, I mean, there are public media reports which says that they had some connection with North Korea. Now I come under the obligation that I'm supposed to report this transaction because my client is exporting to a client in Dubai who had, and again, that is a media report, not been established, but it says even media reports. So there has been a media report that those Dubai clients had some North Korea connection. The entire transaction becomes suspicious. As a chartered accountant, I have to report this transaction as suspicious transaction.
You're supposed to be also be cautious about all the social media reports or whatever news which
Correct.
keep on coming Hindenburg and God knows what all.
Let's say in the UAE, they post-COVID, there was a lot of Russians had invested a lot of money. And it was in real estate also. Previously was in real estate. So a lot of regulators have barred countries that, let's say if I'm a fund in Europe, I cannot borrow from you. Yet, how do I, in that case, now UAE is out of real estate. Now they still have Russian, they have created a vehicle over there, probably 1, 2, or 3 in the same jurisdiction, became unable to buy, etc. Money. Then how do I identify?
In fact, the biggest challenge is in Dubai, the transaction happens through crypto. There is no money trail. Really, really difficult. I mean, those auditors who are auditing companies in Dubai itself, UAE, They say we do not have money trail. I mean, I sitting in India, how do I identify the money trail? So what is the flow of transaction? It would be the reporting entities who would report it to ICI. ICI would compile the information, and then based on its analysis, it would report it to FIU. Now, what is to be reported? As per the FAQ issued by ICI, reporting entities are required to furnish following reports to FIU India through ICI. Cash transaction report if individual transaction exceed 10 lakhs, or series of connected transaction exceeding 10 lakhs within a month, or its equivalent foreign currency. So if this is a transaction which has occurred, or series of transactions the moment it crossed 10 lakhs, by 15th of the succeeding month, CTR, which is the cash transaction report, has to be filed. If it is a suspicious transaction report, it is the red flag indicators which get triggered, and then you are given time to investigate, and moment you conclude that yes, it's a suspicious transaction, within 7 working days from the date of firming of suspicion on such transaction, the professional is required to report it to ICI. If there are wire transfers, if it is exceeding 5 lakhs, then it has to be reported. If there are transactions with not-for-profit organizations exceeding 10 lakhs, then by 15th of next month, it has to be reported. What is the penalty? The penalty on the defaulting reporting entities or its designated directors or employees shall not be less than 10,000, but will not exceed 1 lakh for each failure. So here there is a catch. It says each failure. So if you have a client who keeps on transacting with a country or a client, and there are series of transactions, say there were 30 transactions with that party, and I did not report it, then each one is a failure. And therefore there are 30 failures, so which may entail a liability of 30 lakhs and not 1 lakh. So the biggest concern is, can civil or criminal proceedings be initiated against a reporting entity, being a CA firm or its designated director or principal officer? The answer is no. Prosecution is contemplated by Chapter 4 of PMLA for default in compliance, and Section 14 of the PMLA contemplates that no civil or criminal proceeding shall lie against the reporting entity, its directors or employees. So there are no civil or criminal liabilities. It is only the monetary penalty and the repercussion of that monetary penalty that you will have to bear. One more catch here is, if I have not reported those transactions, I am willing to pay, or I paid. I mean, I made a mistake, I paid that penalty. What could be other repercussion? To my mind, the other repercussion could be you have violated the code of ethics, and therefore ICI could also suo motu initiate disciplinary methods. REs and their directors are prohibited from disclosing or tipping off. See, a lot of time we advise our client, ये ऐसा मत करना, income tax में ये trigger हो जाएगा, notice आ जाएगा. So here, if the client is doing a cash transaction, which are red flag indicators, I'm supposed to report. I can't go and tell my client that you don't do this, else I will have to report it. That is prohibited under the law. If you do this, you have violated the law. So what the law says is, let him do what he wants to do. You are not supposed to stop him. You are not a law enforcement agency. Correct? You are as a responsible citizen. You have observed something. Your job is to go and forget it. You report and forget it. Don't stop him. Nor do you warn him that if you do this, I will have to do this. That's tipping off, prohibited.
One question. Suppose I give the means I give some tipping up, or I reported this entity. Whether there is any protection to the CA
Reporting are always confidential.
With regard to the suppose he comes to know by some
No,
mechanism.
definitely not. Definitely not. Those are very, very secured, because there are, I would say, millions and millions of transactions getting reported to FIU from these banks, intermediaries. Everybody is reporting. They never get it. So there is.
Section also says, section clearly says that you don't have to disclose the name of the person making the complaint. And the first thing ROC did, they forwarded my complaint with name to the company. Despite that section, it is very clearly written in that section. I think it's section 450.
You are complaining in the sense
I made a complaint about fraud. Yeah, I will share with the company.
that doesn't give you protection in the PMLA. That is under the Companies Act.
I was just trying to say that even if it is written, they do it in a very reckless manner. So that I filed a SCP form, which is for serious complaint for frauds. And section says ROC doesn't have to report my name. The first thing ROC did, they downloaded that form and forwarded as it is, where my name, address, phone number, my PAN card, because without PAN and Aadhaar, you cannot file a serious fraud complaint. They forwarded everything. Everything. And that company was after my name.
Surprising, but I mean, I have not come across cases from FIU. And here, anyway, you are not even directly reporting to FIU.
What he's trying to make a point is that, yeah, law is very categorical enough as far as his experience vis-a-vis MCA is concerned. It has not been following the confidentiality norms, but which it ideally should have. However, probably PMLA is enforced by a different set of authority, which is little more, I say, compliant of confidentiality norms.
No, yeah, and again, what happens is, I mean, these are all electronic reportings. There are no manual reportings. So electronic reportings are more secured because then even people in those organizations do not get complete visibility.
They have not even taken pains to, complaint was attached to the form. They have not taken pains to, detach that complaint and forward it to company.
Surprising, but maybe yes.
And it happened, I find 91.
So what are the report? I mean, the record maintenance requirement is that all records pertain to cash transactions, which are more than 10 lakhs, series of cash transactions exceeding 10 lakhs, transactions involving not-for-profit organization exceeding 10 lakhs, cash transactions with forged or counterfeit currencies, suspicious transactions, and cross-border wire transactions more than 5 lakhs, purchase and sale of immovable property exceeding 50 lakhs. All these are transactions for which records have to be maintained. The records are to be maintained with respect to evidencing identity of its clients, beneficial owners, as well as account files and business correspondence relating to its client. So business correspondence could include even your exchange of emails. So even those has to be maintained and not only the transaction related.
One question which I had as regards the cross-border transaction. If I understand, if you have to make an outward remittance, you need a CA certificate, which is mandatory. The client has said the purpose, it is obviously either through an email or we have taken the written representation that the purpose of this is for some ABC or whatever is the identified purpose. Amount is around 8 to 10 lakhs. Are you supposed to actually get into the details? Is it really for that
So
purpose?
again, when you are issuing 15 CSCB, you are doing attestation function, not for the So that is not.
With a suspicion, should I'm
No,
more.
that is under your obligation as a chartered accountant when you do attestation function, not under, I mean, not as a reporting entity under.
Understood.
So the records have to be maintained for a period of 5 years. How it is to be maintained has been also specified, and it says you should include nature of transactions, amount and currency, date of transactions, and parties to the transaction. One more thing that would be made applicable because you will become a reporting entity is you will have to do stringent screening of the employees at the time of hiring. Most of the time we get people who are with references. We don't even obtain the identity or address proof. So, I mean, even those screenings will have to be done. Most of the large organizations, CA firms do that, but it would be, I would say, a more level 1 plus 1 level of review. Regular training should be provided to your staff, which should include KYC, customer due diligence, sanction screening, record keeping, transaction monitoring and review. And you should have instruction manual, and that should include all these areas in the training manual. Periodic review of policies and procedures should be done. The periodicity of the review has not been defined that at what periodicity it should be done, but it is left to the discretion, but it should be reasonable. We will not go into what is the role of ICI, but more of it is a nodal agency to facilitate these transactions. While we have completed what was envisaged for the today's meeting, I would also like to draw the attention of the participant to this 9th May notification, which is more wider than a 3rd May notification because it includes financial transactions carried out in the course of business on behalf of or for another person, acting as a formation agent of companies and limited liability partnerships, acting as a director or secretary of a company, a partner of a firm, or a similar position in relation to other companies and limited liability partnerships, providing registered office, business address, or accommodation or correspondence and administrative addresses for corporates and LLPs, acting as trustees and express trust or performing equivalent function, and acting as a nominee shareholder for another person. These are a lot of activities which chartered accountants generally do, and they should understand that though we may not become reporting entity under the 3rd May circular, but definitely 9th May notification would cover all these activities which chartered accountants generally do.
Sure. We require two people to incorporate
Correct. So
company.
they appoint chartered
Just you
accountants,
nominate.
virtual CFOs and chartered accountants. Correct. So there was a clarification to that notification, which will not go into. But they have said that whatever is envisaged would broadly also include companies which are providing trust and company services providers. They are called TCSPs, which is trust and company service providers, and they are all reporting entities under PMLA. And they have to do direct registration with FIU India through FinNet Gateway. These are the references. I mean, those who are interested in studying PMLA and all these guidelines further, they may refer to this material. These are the link to forms of ICI in case you are required to be registered as reporting entity. There is a link to the KYC norms issued by the ICI, and there is a link to the sanction list provided by the ICI. Thank you, friends, and I am thankful to BCS for providing me this platform, especially Preeti Ben, who had been after me for a long time to take up this session, maybe almost a year. And really thank you for being after me to ensure that I deliver this session, and I hope I have delivered it to the satisfaction of the
It's
participants.
our pleasure, and I can say we've been fortunate enough to get you for such a wonderful session, eye-opening session, awakening session, so to say.
Thank you, my pleasure.
Participants, if they have any questions, they may raise their hands or they may put it in the chat box or the Q&A box. We will be happy. There are 4 questions. If CA is unaware about his appointment as executor of his will, in such scenarios, will he be covered under the provisions of PMLA?
See, it is only when he starts executing, he becomes an executor. Just naming him doesn't make him a reporting entity. Correct? So unless the person has passed away, and then now he starts as an executor, that is where he becomes a reporting.
Is a virtual CFO working as part-time employee covered as a reporting entity?
Yes. Virtual CFOs, provided they do transactions on behalf of the company. If they only provide advisory services, they are not covered.
All cash transaction means which are not recorded in the books of accounts required to be reported.
Here the cash transactions that are, see, unless it comes to your notice and if they are not recorded, the question is, I mean, we are not talking about those cash transactions which are not recorded. These are those cash transactions which are legitimately allowed. Like say, for example, a company is into agriculture business and it is allowed to receive cash because in mofussil areas you do not have banks. So there is no prohibition. So you would have recorded those cash transactions in his books of accounts, and that is where you are required to do.
Whether employees of the companies can be considered as REs.
No, they are not chartered accountants holding COP.
Yes. If CA is acting as trustee or committee member of trust society carrying charitable activity and registered under section 12A, whether he will be a reporting entity.
The question is whether he has accepted that assignment in his professional capacity or personal capacity. He will have to differentiate that, take an engagement letter that it is in his personal capacity, then not covered. If it is professional capacity, yes, covered.
As a tax auditor, what obligations are cast on the chartered accountant? Nothing.
Then he will be covered only by code of ethics.
In case CA is in GIFT City, any changes in the points discussed?
No, you are still within the jurisdiction of India.
Is only real estate agent required to get registered or any other compliances further to be?
No, as such, real estate agents is not today's topic, but all those reporting entities, I mean, whatever they are required to do is common. I mean, do enhanced due diligence, do KYC of your customer, do a sanction screening, reporting, identifying suspicious transactions, that all would apply, even to a estate agent.